Welcome to TMS Insights, end of September 22. It's been a really interesting year this year so far, and we've had all forms. Last time we spoke to you, Ben, we were talking about the reporting season. That's the thing we know about. We know that was a pretty good season. What's happened since, actually, the market's taken another turn down, similar to the one it had in May.
Yep.
Really all about monetary concerns. But there's a number of things to say, but from a starting point, the biggest move in the market is really that unwinding PE, isn't it?
Yes, and which has all been driven, and this without wanting to be boring, by inflation,
Yep.
which is putting pressure on interest rates as central banks have gone from at the start of this year saying, don't worry about it, it's going to pass through, to now, we're going to attack this head on.
Yep.
We've seen the lessons of the past. And as we see bond yields continue to move higher, we see valuations contract.
Yep.
So to date, this is not an earnings issue.
No.
If you look at the last 12 months, earnings across the ASX 200 grew 15.5% on a rolling 12-month basis. Share prices have fallen quite significantly. So the market's got a lot cheaper.
About 20% decline in PE.
Yes.
Which is bigger than the market fall.
That's right. And for the industrials, because, resources are a bit of a volatile thing in there.
Yep.
For the industrials, last year we saw sort of 8% earnings growth and now about 13% share price decline. So about a 21% improvement in valuation.
Yeah.
And this has been happening on global markets as well. We've seen particularly in America.
So we look at the S&P now, and you've got some stocks there that are different to the components in Australia, and I think most people would readily admit that they deserve premium multiples, remembering better companies will get better PE multiples and the like. But now across the board, and particularly if you extrapolate those, the FANG stocks, if you like, you're getting really good valuations on a long-term basis.
Yeah. And that the irony is that US market in the last 12 months, their earnings are actually growing faster as a market than Australia. But the market has fallen far more heavily than Australia because they don't have a lot of resource and energy stocks.
Right.
But just a couple of facts. On a trailing PE basis, the S&P 500 is on its lowest PE since 2015, 7 years now. If you strip out the FANGs, which kind of morphed their market a little bit, the S&P 500 is on a PE of 12 times. So markets both in the US and in Australia are pricing in, to me, quite a substantial decline in earnings, which we're actually not seeing yet.
It hasn't happened yet.
It hasn't happened yet.
No.
There will be a decline, I think, across the market, but maybe not nearly as bad as what the market's pricing in.
And it's also fair to say that's the part we think about. You don't know. The things we know is the economies are running very strongly at the moment. You don't get these reads on unemployment at really record lows without that. And I want to just pause on that for a moment to sort of consider what this interest rate move is. I mean, interest rates are incendiary stuff for newspapers to take on, and then they throw in other words that really excite people. But we're really seeing a normalisation in this interest rate market after the COVID years, which was excessively low.
Yeah. I think the thing that's unnerved markets is how quickly rates have been normalised.
Yeah.
It hasn't been a steady over time process. There's been almost a bit of panic about it, I would say, particularly in the last couple of months. That really comes back to, again, central banks, and it wasn't just Australia's, it was every central bank around the world, felt that the outset of inflation was really a reopening byproduct across the world. Right. And it's persisted. And it's broadened into services as we've all gone and spent money on travel and gyms and pubs and clubs and, all those sort of things. So, but I've been showing a chart to clients which shows that what happens if we see 0.2, 0.3% month-on-month increases in inflation, we'll be back to target levels by about May next year. And if we get a couple of months, like 2 months prior, which was a negative 0.1, it could be quite a bit earlier than that.
Yeah.
But to me, central banks, they're beating their chests. They want us all to stop spending money so aggressively because that is what's fueling this fire. And I think they're hoping they don't have to follow through on what they're saying they'll do.
They've always rather do the act of jawboning, talking about things so that everybody listens. People aren't listening because there's momentum in an economy.
Yep.
And a lot of spending decisions don't actually materialise for months. You make the decision and it impacts on the economy later. So if you put the brakes on, it takes a while to slow.
Yes.
And that's the thing. So we are going to see this spilling into the new year a bit. From an equities point of view, though, and I think going back to that valuation issue, it certainly means volatility. We've seen that this year. Volatility has upside in it as well as downside. We're now down about to those June lows, okay? We're about 1,200 points off where we were at the start of the year, rough numbers. Okay, so it's a material move down, and it's impacted on good stocks and bad stocks, isn't it, Ben?
That's right. It's I would say there's been a change in composition. Like I was looking through at what a range of businesses got down to in mid-June when the market last got to this level. And I'd say that there's a number of companies that are now materially above where they got to then, but the share market is at the same price. So to me, it's kind of, in June, it was everything just got sold off. And the higher the PE you're on, the more aggressively you got sold off. Then we went through earnings season and a number of companies came out with pretty good results. And they're materially ahead of where they were back in June, despite the market being where it was back in June. And I think this leg of selling we've seen recently has been the more economically sensitive businesses, your Blue Scopes and the retailers, the things that are exposed to a potential slowdown in the economy. The businesses which are earning money in US dollars, I think, is becoming a bit of a theme.
So the currency has moved wholesale. So it's been a flight to the US dollar, the strongest currency around, and at the expense of all currencies, really. We've seen the Bank of Japan defend the yen. We've seen the Bank of England get very confused with its government and what they're doing. The ECB really was the slowest to move on rates. But the Fed's moved and very aggressively, and the dollar's been the beneficiary of that.
And they're exporting.
And they're exporting.
Their problem.
Well, they have to. And again, these things are not quarantined by national borders, are they? So it is going. It is interesting to touch on this while we're talking about China's cutting, and again, stimulating. So
and still locking hundreds of millions of people up, which is, so the other... I've been saying to clients there's a couple of things. Firstly, clearly Russia is ramping back up for a further escalation in the war. That's not good for global growth or for inflation, probably. China is still locking down hundreds of millions of people for a couple of cases of COVID. So both are remaining issues. The weird thing about 2022 is normally at this point in the cycle, central banks would be starting to kick in and say, we've got your back. We'll start cutting rates if we do see this downturn play out. And the bizarre thing about this year is that they're talking about aggressively raising rates when the market can see a downturn is coming. And that's I think that's what's causing this extra volatility.
But equally, they need to have rates at a level they can cut when they really need to.
Yes.
And they really
And that's the 2024.
And that's right. And so that'll be how they position themselves. In terms of equity markets overall, we know that we're down now at a low point, Ben. When we look back over a long period of time, we see that this year so far, from January 1 to now, has been one of the worst, maybe 5 for markets, both bond and equities, from January to September. Typically, though, the data also suggests that we do get a positive year-end finish in those years. Those things are now set up because the level of the market is, in a relative sense, so well priced.
Completely. And I think, I've been at pains to say, this is not a GFC style event. Markets have actually fallen further than the first part of 2008. The difference this time versus then is that debt is remarkably low.
The balance sheets are good.
Great. And last time they weren't.
No,
they were
stretched,
and contingent on short-term refinancing.
Yeah, they were.
So there's a big difference there. Earnings are growing. Valuations have got cheaper. The missing piece of the puzzle, we need to start seeing further evidence that inflation is turning over.
Yeah, that's right.
And then the bond markets will start reacting to that, and that could see share markets rip into the end of the year.
And there are factors at play. We know some of the key components in inflation. Many of those factors will come well off their highs, whether it be energy, food goods,
shipping
costs, bulk commodities.
Yep. Car prices, used car prices,
base metals. So they're all well off their highs. A lot will play out in the months ahead. Want to talk about one stock, and it's one of our all-time favourites. Two, effectively. All-time favourites. Soul Pattinson Brickworks reported last week, and we know Soul Pattinson has always run that diversified model. Ben, this proved out really well how well being diversified is, and solid management over a long period of time can deliver exceptional results.
Absolutely. A cracking result, declared a special dividend as a result of partially probably the cash splash from New Hope, which is coming through to them. Yep. Diversity of earnings, great balance sheet, a company that's makes long-term decisions and doesn't worry about short-term outcomes. You often find will get the best long-term and short-term outcomes, we tend to find. And, Brickies, which, I think also just had an incredibly good result. And everyone thinks of the bricks. It's like Salt Pats, they used to think of the chemists. You used to say, what are the sunscreen sales like? They must be good. Brickworks is always... People think of the bricks. It is a part of the business, but the land bank and the rezoning and the recycling of that land with this partnership they got with Goodman Group is really starting to come through.
Yeah. And consistently every time, every report, it's showing how that they're unlocking value every period.
Yeah.
It's fantastic.
And with every period, that dividend just keeps going up and up and up and up.
We're really surprised with big lift in the Soul Patts dividend to 43 cents and a special of 15, which is a really good jump there. Again, Ben, just saying about how to invest long-term like Soul Patts do, take a position and play this across the market, across your portfolio, is think long-term. And when you can see we're below trend like we are now, we believe we're well below trend on the index level at the moment, long-term returns can be really attractive from this point on.
Absolutely. That's everything is set up nicely for the next 5 years to be a lot probably better than the last 5 years, I would say, because valuations are so much cheaper.
That's it.
And so this is when everything is telling you it's all going to hell in a handbasket. This is the time you get really bullish on equities. The piece in the puzzle is that inflation piece.
And there's always a piece that's missing. It doesn't make all sense, but not getting caught up in the fear, but seeing the opportunity that exists is how you do well in investment markets.
Because if you wait for that piece to look like it's getting better,
it's overpriced.
It's too late.
Yeah, that's right.
That's the market.
When you see a bandwagon, it's too late to get on. Yeah. Well, that's all we've got time for today. We'll be back in October with another update.